Hello everyone, and welcome back to Boss Economic World, where we peel back the layers of the financial onion without making you cry unless, of course, you're shorting the euro today. I'm your host, the Boss. Today is December 9th, 2025. Grab your coffee, or if you're in Frankfurt, your sparkling water. We need to talk about a massive plot twist in the global economic movie. You know the script we've been reading for the past 6 months? The one where inflation dies, central banks hold hands, and everyone cuts interest rates into the sunset? Well, take that script and throw it in the shredder. While the Federal Reserve in the US and the Bank of England are still sweating bullets, trying to figure out how to cut rates to save their slowing economies without reigniting inflation, Europe has just gone rogue. Specifically, the European Central Bank has decided that the party is over, the lights are on, and the music is getting louder. The protagonist of today's drama is Isabel Schnabel. She's a member of the ECB's executive board, the Hawk of Frankfurt, and let me tell you, she just dropped a bombshell that has traders rewriting their algorithms. She isn't just pausing rate cuts. She is signaling comfortably, I might add, that the next move for Europe isn't down. It's up. That's right. A hike. In this economy? In 2025? Today, we are going to dissect why Europe is suddenly the bodybuilder of the global economy, how they survived the Trump tariff turmoil better than anyone expected, and why your cheap mortgage dreams might be dead on arrival. Let's get into the truth behind the money. Let's set the scene. For months, the narrative has been simple: the economy is cooling, rates must fall. President Christine Lagarde, the head honcho of the ECB, has been diplomatic, using phrases like rates are in a good place. That's central bank code for, we have no idea what we're doing next, so we'll just sit here. But Isabel Schnabel? She doesn't do diplomatic ambiguity. In an interview just last week from her office in Frankfurt, she looked at the market bets, which are currently pricing in a rate hike, and said, I'm rather comfortable with those expectations. Do you understand how wild that is? Usually, central bankers fight the market. They say, oh, you silly investors, you're getting ahead of yourselves. Schnabel is doing the opposite. She's saying, you guys are finally getting it. Currently, the deposit rate is sitting at 2%. Analysts expect the ECB to hold it there for a fourth time when they meet later this month. But Schnabel is the first policymaker to come out and say that 2% isn't just a pit stop on the way to zero. She believes we have reached the floor. Why? Because she thinks the risks to inflation and the economy are tilted to the upside. Now, let's translate tilted to the upside from economist speak to English. It means the economy is getting too hot to handle. It means that while you were worrying about a recession, Europe was quietly hitting the gym. Schnabel signaled that the new growth projections coming out this December might be revised higher. She explicitly stated, both markets and survey participants expect that the next rate move is going to be a hike, albeit not anytime soon. This is the financial equivalent of a mic drop. While the rest of the world is worried about deflation or stagnation, Europe is worried about booming too hard. How did we get here? To understand Schnabel's confidence, we have to look at what is actually driving this European renaissance. It's not magic, it's fiscal plumbing. Schnabel outlined 3 specific engines that are bolstering the economy, and barring any massive asteroids hitting Brussels, these engines are running hot. 1. The consumer comeback. Remember when inflation was eating everyone's lunch in 2023 and 2024? Well, wages in Europe have finally caught up. We are seeing rapid increases in pay across the Eurozone. But here's the kicker, unemployment is near a record low. Usually, when you hike rates, people lose jobs. That's the brutal calculus of economics. But Europe has defied gravity. Companies are hoarding labor because the demographic crisis means workers are gold dust. So, people have jobs, they have higher wages, and guess what? They are spending money. 2. The government spending spree. This is the big one, folks. We are living in a geopolitical powder keg. The war economies are real. Schnabel pointed to a jump in government outlays on defense and infrastructure. Since 2022, Europe has been forced to rearm. We aren't just talking about buying a few tanks, we are talking about a structural shift in the economy toward the military-industrial complex. Governments are pouring billions into factories, ammunition, and cybersecurity. That is government money flowing directly into the veins of the private sector. It creates jobs, it creates demand, and yes, it creates inflation. 3. The AI investment rally. It's not just Silicon Valley. Europe has caught the AI bug. Schnabel noted a rally to adopt AI technology is bolstering investment. For a long time, Europe was the old world that made nice cars but didn't know how to code. That's changing. From German automotive lines integrating predictive AI to French fintech optimizing algorithms, capital investment is surging. Companies aren't borrowing money to survive, they are borrowing money to upgrade. Now, we have to address the elephant in the room. The orange elephant. President Donald Trump. When Trump returned to the White House, everyone predicted an economic apocalypse for Europe. The narrative was that his aggressive tariffs would crush the German export machine. The logic was sound: if America puts a 20% wall up, Mercedes and Siemens suffer. But here is where the Boss Economic World analysis gets juicy. Schnabel says Europe has weathered the tariff turmoil surprisingly well. She said, growth has been much more resilient than could have been expected in the face of the greatest disruption of the international trade order since the Second World War. How is this possible? 2 reasons. First, uncertainty dropped. As Schnabel noted, one reason why the impact of tariffs has been milder than expected is that uncertainty has come down quite quickly. Markets hate maybe. They can handle bad news, but they can't handle maybe bad news. Once the tariffs were announced, businesses stopped panicking and started adapting. Second, trade rerouting. Europe didn't just sit there and cry. They pivoted. We've seen a massive rerouting of trade away from the US and China and toward intra-European trade and emerging markets. Plus, the downward pressure on goods due to potential trade rerouting from China has been muted. The data backs her up. The ECB's last forecast said growth would slow to 1% next year. But Schnabel says the outlook has brightened. Friday's data drop showed the third quarter performed better than anyone thought. The apocalypse was cancelled due to lack of interest. Okay, so the economy is growing. That's good, right? Why do we need to hike rates? Why can't we just enjoy the boom? Because of our old nemesis, inflation. But this isn't the inflation of 2022, which was caused by gas prices and supply chains breaking. This is sticky inflation. Schnabel points out that while overall inflation is in a good place, services prices remain the most important challenge. Why? Because of those wage rises we talked about. When your barber, your waiter, and your lawyer all get a raise, they charge you more. That creates a loop. Here is the most dangerous sentence Schnabel uttered: the decline in core inflation has stalled at a time when the economy is recovering, the output gap is closing and fiscal policy is expanding, all of which would tend to be inflationary. Let me break down the output gap for you. The output gap is the difference between what an economy can produce and what it is producing. If the gap is negative, you have room to grow without inflation. If the gap closes, every extra euro spent just drives up prices. Schnabel is saying the gap is closing. Europe is running at full capacity. If the government keeps spending on defense and companies keep spending on AI, and the ECB cuts rates, boom! You get 5% inflation again. She warns, this has to be monitored very carefully. There was a fear that the EU's carbon pricing system would drag the economy down in 2027. Schnabel dismissed this. She's shifting the goalposts on inflation targets. She argued the ECB can tolerate moderate deviations from target as long as it's not permanent. She said, it's important not to pin things down to any particular number. What really matters is the overall macroeconomic narrative. Translation: we aren't obsessed with 2%. We are obsessed with preventing a 1970s-style spiral. Here is where the story gets really interesting for the global macro nerds. We are seeing a great divergence. In the US, the Federal Reserve is in a bind. They halted their balance sheet runoff this month. Why? Because the US economy is showing cracks, yet inflation remains sticky. They are cutting rates to keep the patient alive. The UK is in a similar boat, stagnation nation. Contrast that with the ECB. Schnabel says their balance sheet runoff is progressing smoothly. Money market rates are stable. Liquidity is abundant. She explicitly noted the contrast, that contrasts with the US, where the Federal Reserve halted its rundown this month. While Bloomberg Economics suggested the ECB might follow the Fed and stop tightening next year, Schnabel laughed that off. She said that prediction is at one end of our range, while the other end is much later. This is a flex. A massive flex. The ECB is effectively saying, our banking system is healthier, our liquidity is better managed, and we don't need to panic stop our policies like the Americans. For the last decade, the narrative was that the US economy is the race car and Europe is the bicycle. Right now, it looks like the race car has a flat tire and the bicycle has slapped on an electric motor. We cannot ignore the political dimension here. Isabel Schnabel is a German hawk. In central banking zoology, hawks like high rates to kill inflation, doves like low rates to boost jobs. Schnabel has expressed interest in potentially following Christine Lagarde as the next president of the ECB. By taking this hardline stance, being the first to say the floor is in and we might hike, she is positioning herself as the guardian of the euro's value. While Lagarde is singing K Sarah, Sarah, Schnabel is writing the sheet music. She declined to comment on exactly when the next hike is coming. Some analysts are betting on June. Schnabel gave us the classic, we'll cross that bridge when we come to it. This is not currently on our minds. But then she immediately followed up with, we have to monitor whether our policy becomes more accommodative over time, which would then be a time to think about another rate move. That is central banker for, get ready, it's coming. So, you've listened to the analysis. You understand the output gap and the tariff turmoil. But what does this mean for your wallet, your portfolio, and your life? 1. The cheap money era is officially dead in Europe. If you were waiting for mortgage rates to drop back to 1% or 2% before buying a house in Europe, stop waiting. It's not happening. If the floor for the deposit rate is 2%, commercial rates will stay closer to 3.5% or 4%. You need to adjust your business models and your personal budgets to a higher for longer reality. 2. The euro might strengthen. If the ECB is hiking while the US and UK are cutting, money flows to where it gets treated best. Traders will sell dollars and buy euros to get that higher yield. This is great for European tourists visiting New York, but it's a headwind for European exporters. However, as Schnabel noted, the exporters are adapting. 3. Stocks, look for quality. In a world where capital costs money, zombie companies will die. The AI boom is real, but it favors companies with cash. Look at the sectors Schnabel mentioned: defense, infrastructure, technology. That is where the government money is going. Follow the government money. 4. Watch the wages. If you are an employee, this is your moment. The labor market is tight. Ask for that raise. The ECB expects you to get it, that's why they are raising rates. Let's wrap this up. For the better part of 15 years, Europe was in a coma of negative interest rates and deflation. We got used to the idea that the ECB's only job was to perform CPR on a dying economy. Today, December 9, 2025, marks the psychological end of that era. Isabel Schnabel has looked at the data and declared that the patient isn't just alive, the patient is at risk of partying too hard. The combination of AI adoption, defense spending, and a resilient consumer has created a Teflon economy that even Donald Trump's tariffs couldn't stick to. Is it risky? Absolutely. Hiking rates into a geopolitical storm is a bold move. If that AI bubble bursts or the war in Ukraine spirals further, Schnabel's hawkishness could look foolish. But for now, she is comfortable. And if the German hawk is comfortable, you should probably be paying attention. As Schnabel said regarding the ECB's future operational framework, what really matters is the overall macroeconomic narrative. And the narrative today is clear: Europe is back, inflation is lurking, and the rates are going up. This has been Boss Economic World. I'm the boss. Keep your eyes on the data, keep your powder dry, and remember, in the world of economics, the only certainty is that the consensus is usually wrong. See you in the next episode.